Hey guys, how are you? This is Ishai Breslauer, your host of the CRE Shark Eye Show. Hope you guys doing fantastic today. Today with us, we have Deborah Smith. So Deb Smith is the CEO of CenterCap Group. They're an investment bank, and she has been doing so many things. We're going to talk about all the stuff that we're going to talk about investment banking, about real estate, and a bunch of more things. Deb, thank you so much for being with us.
Thanks for having me.
My pleasure. You know what? Before we start digging into your story, give us like a 2-minute elevator pitch about your business.
Sure. So the CenterCap Group is a boutique investment bank. We focus exclusively on the real estate sector. We work with owners, operators, REITs, investment managers, you name it, on thinking through growth strategy, capital raising funds, to buying and selling corporate on the M&A side as well, all within our industry. And so at this point, we've been doing this for quite some time. So suffice to say, we know a lot about real estate, and we know a lot about what's going on in it.
Perfect. So it leaves us, meaning such a huge spectrum of things you probably dealt with, and we're going to talk about all that. But you know, before we even do so, let's go back in time. How did you get into this? A long time ago.
I fell into it. So I actually went to law school. I grew up in Australia. I'm a dairy farmer's daughter. So grew up in rural Australia and managed to get from high school into college. Was not on the cards, was not on the radar. Never thought that something like that would be open or on the table for me. And had a very good teacher in high school who took me under their wing and said, you should think about this. So I applied, I got in, and I did a double degree at the University of Sydney. And then I was very fortunate to get a banking job out of college with Morgan Stanley. I was going to be a tax attorney and chose to go down the banking route instead. I didn't know much about banking, pretty much didn't know anything about banking. And so I started there. It was an amazing opportunity with some amazing people. And I was fortunate to get shipped off to the New York office from Morgan Stanley. And I've been here ever since. And so
when was that, by the way?
Pardon?
When was that? Which year?
It was back in, I came over early 2000, around 2000, 1999, 2000 is when I come to the States. Yeah, I was here for a loaner, just for a year. And I did power and utilities. I was an energy banker by background, and ended up staying here in the United States and moved to a couple of different firms on the basis that I didn't want to be pigeonholed as an energy banker. And so I moved over to Wachovia Securities from Morgan Stanley and expanded. I wanted to do healthcare banking, actually. And it just happened to be in 2005 where the market was incredibly hot for real estate. I didn't know anything about real estate at all. I had never crossed my radar. And I was put on a real estate deal, and the rest is history. And so after years of looking to avoid being pigeonholed as a one-sector banker, I've now been doing real estate since 2005. So 17 years in, and now I'm a real estate banker. So so much for planning.
It's amazing. But, Morgan Stanley, and then going to CenterCap Group, how long does that exist?
So I moved from Morgan Stanley to Wachovia in 2005, and then we started up the CenterCap Group in 2009.
Wow.
So through there, it was a stint. I was fortunate enough to work at Lehman before it blew up, and I was fortunate to run CBREI Global Investors, their global M&A business. Through going into the downturn, which was an amazing opportunity to move out of the banking side to be an in-house captive banker, at which I considered a fantastic, phenomenal franchise at CBREI Investors. And then, coming out of that, it was a tough market, a very tough market. And we decided to start up CCG on the basis that there was not enough bankers who really there wasn't any, had on the ground knowledge of the real estate space. And we were covered by so many banks when we were at CB. And what really struck us is how few of them really understood our business. And so, which left us thinking, well, how can, advisors advise us on what to do with our company when they didn't really understand what we did? And so that was kind of the genesis of us starting up CCG, thinking there was just a massive gap in the market for folks that understood capital use as well as capital deployment, and then how to think about that in the context of growing your business within the real estate market across multiple sectors, multiple opportunities on the risk reward spectrum, and bringing that all together, we thought required a unique perspective on the sector. And that's what we wanted to build our business around.
Okay, I have so many questions. Okay. All right, I'll tell you what. Let's start from the juicy part and then get into the detailed business part, like the more technical stuff that I'm very interested about. But I'm sure the listeners, we don't have a lot. Meaning, I had people who went through the downturn and went through all kinds of things. But you mentioned in the middle sometime you worked at Lehman's. When was that in terms of years?
So where I was there, smartly, one of the smartest things was moving to Lehman that I did in my career. I went with a team, and we were looking to build out Lehman's M&A business on the real estate side. So I was an M&A banker by background, and really enjoyed the execution side of the banking business, and spend most of my time advising on the buying and selling of corporates. And so working at Lehman was a fabulous franchise. I had a really strong experience, but left right before the market turned.
Wow.
Yeah, so left before the market turned.
Which was when? About 2007?
Around 2007. Yeah, 2007.
So tell me 1 second, meaning not a lot of people have this type of experience. Because and I'm a big buff of what happened then, meaning I'm not that young, by the way, but I got into the business later on. It's a long story about my career, but I felt it as an adult, obviously, meaning the downturn and so on, but as a businessman less, meaning I came in after. But I'm very interested about, meaning you were there in Lehman, okay, doing M&A deals. Lehman is one of the largest banks in the world, okay, literally. Especially when it comes to investment banking, real estate, M&A, meaning we know what they did, what they were involved in, and so many banks all over the world invested in them, meaning it was such a ripple effect. What did you feel did you know anything? Did you feel anything of what's coming when you were in Lehman? Was there anything that you felt there where after, obviously you couldn't predict, I'm assuming, but once it happened, could you say back, wow, that is so... it came, meaning I could see it coming, meaning it's something that could have been predicted.
Well, look, I was on the advisory side. And so when I left, the market was very strong, so I wasn't on the principal investing side at Lehman, and I wasn't on the lending side either. What I did was more on particularly go privates for the public REITs. And so that was more of where my focus was, being in the banking group. And so it wasn't, for me, I moved out. I wish I could say I had a crystal ball, and I wish I could say I fortuitously moved over to CB when the market was strong, knowing something was going to come. But the reality is, the market was solid. We were getting a lot of deals done, and the CB was just an amazing opportunity to go in-house and work on doing corporate deals from the private equity side of the business. And it was pretty much that simple. It's we went on, once I moved over to CB, then we became wholly focused on internally working on executing and looking for opportunities within that platform. So I actually went home to Australia in 2008, and pretty much when I came back around that time, Bear Stearns had gone under. And I remember thinking, what just happened? Crazy. With Lehman going under, I wasn't there and wasn't a participant there either. So we were focused, once I moved over to CB, in building out our own business and focusing on how to do smart and good deals for them.
And 2009 comes in, and that's the time where you opened CCG. Is that correct?
Mm-hmm.
Right.
Yeah.
Now you said something very interesting. You said that you opened it because you saw the connection between the massive gap between capital and the business growth, and there's something unique about, meaning you saw something unique in it. And I'm very curious to hear what was the unique thing that you saw that you guys do today, which is basically differentiates you guys.
That's a good question. So I think today it's as much true as when we started, is that our business goes along three material lines. The first is which is where we started the business, which is around capital raising for one-off opportunities. So there is an owner or an operator is looking for capital for either acquisitions, portfolio acquisitions, development deal, and we would introduce them to capital sources. And we've grown that business to focus now on top-ups for funds and expanding that business out. But along the way, we've become a material player in the buying and selling of corporates, particularly middle market investment managers. And we've really built that business out as well. And then the third piece is, we bought a consulting business a couple of years ago, maybe 3 years ago. And now we have a consulting practice. And so it focuses on, succession planning, fairness opinions, valuation opinions, business strategy, preparing yourself, helping you think about what you need to go public, or, you're looking to become more institutional to go out and raise funds, or helping you think about strategy and growth and how to bring out the best of who you are and strategies. And so all of those business lines, we don't believe there's another firm that has those business lines the same way we have it within one team. So we bump up against different folks and different aspects of our business, but we don't really bump up against the same folks on all of them. It just depends on what the avenue is. The consulting business is a consulting practice, right? And so you bump up against consultants. The capital raising, you tend to bump up more against the placement firms. And then on the M&A, you bump up against, middle market banks that do much more advisory work, particularly for REITs and owner operators. And then there's a scale issue. We don't have a balance sheet. We don't have trading. We don't have research. And so the top tier is not where we're really focused. We're more focused on the middle market, because in that market, we have our corporate expertise from careers in bulge bracket banks. We have the buy side expertise from being on the buy side at CB, and we've built our business from scratch ourselves. And so we've gotten pretty good at client selection and figuring out what can hum and what doesn't. So that ends up being very unique, and then we only focus on real estate. So, one of the things we saw, particularly at the larger banks, is that real estate, financial sponsors, insurance companies, investment managers are all covered out of different groups. And then you have to get groups to coordinate in order to share information. We have that all in the one team, right? And so, we have all these different providers of capital, from pension plans and state sponsors to corporates and REITs, investment managers, insurance companies, but we have all those relationships in-house in one team. And then you marry that in with the capital raising, it means you get to be in the funnel where you know what capital users need and the opportunities they have, but we also get to know what folks are looking to deploy capital into, what their allocations are, what their mandates are. So it allows us a really unique spot to see not only where there's a match, but also to be able to understand where we think, or taking risk on where we think the market is going and where we think opportunities are coming, so that we can use that for our own client selection abilities.
It's interesting. I just want to focus on one thing to see if I understood it correctly. So you have the consultancy on one hand, meaning that's raising capital, that's the connection, that's the, between the, I guess, the equity or debt and the sponsors of any sort, within the real estate sector, which we're going to talk about in a second. And then you have another thing that you built, which is more the advisory. And while you were talking, meaning give the, I would say, evaluations, business planning, et cetera, which is more retainer-based type of stuff, which is, by the way, very good business strategy that you've made. But it came to me in the middle, and you pretty much answered that, meaning I thought about all these big guys like EY, BDO. I'm missing a lot of them. McKinsey. I don't know. A lot of those guys, the accounting firms / consulting groups that are giving all these, that provide those types of things. And then you came to say, and then you said, we have a very unique mid-market type of clientele. And what I want to ask you is, when you say mid-market, what do you mean in terms of numbers or size?
Yeah, usually it's anyone up to, it's our client base tends to be anywhere 5 to 7.5 billion assets under management is kind of our range. Although I would say over time, we're continuing to upscale the sizes of the relationships. So we're doing more work, particularly counterparty work, for a lot of the large top 20 investment managers or owners of real estate globally. And so as a result, we play in that end of the market, but our niche, where our advice is most valued, a lot of the time tends to be more in that middle market. Although I think, some of our relationships we've had for quite some time. And so as they've gotten larger, we've continued to move with them and retain them as clients too. So I think at this part, it's where we definitely focused on that middle market, particularly on the private side, that we've continued to now work with many of the larger providers of real estate too.
I want to dig in for a second into the types of real estate, that asset classes, and how you guys dealing with them, because they're different type of expertise. Obviously, you have this large player that has a lot of multifamily under management, and then you have this retail person, and then meaning the retail company that does retail all over the country, and then you have office, and then you have hotels. And you have different type of asset classes, and then you have those developers that come with all kind of ideas and mixed use developments, et cetera, different locations, different areas. In terms of an expertise of that type of a firm of yours, how do you manage to maneuver between those asset classes in terms of expertise, and to know who to go to, how to raise capital for them? Or you need to understand also their business, and that's sometimes very different businesses.
Yeah, so over time, our database and relationship touch with the folks that are on the ground, and when I'm talking those owners, operators of real estate, service companies, REITs, and investment managers, all these folks that have access to the ground real estate, when you do nothing else but work with those people, you learn a thing or two. And we're curious, and we take a very active interest in their business. So where a corporate advisor may touch it skin deep at the corporate level when they work, we drill down into what they're actually doing every day of their lives from the asset level. And when you do that across hundreds of parties, you get really good at seeing where one manager or one owner is better at it than someone else, when someone is lucky versus smart, or smart versus lucky. And so a crux of where we get to by being an industry specialist is our core strength really is we're really good at underwriting good management teams with good ideas. That's it. We're really good at that.
It's very exciting. I want to hear if you can give me like a live example where you work with an operator and you see, my God, they're good. And you learn something with them together, or from them, or you taught them something, but you could appreciate that they are a real valuable player in the marketplace. Where can you give me an example of where you found the eureka moment? Oh, here, that makes me understand that they are really good.
Yeah, so look, I mean, we put out CCG perspectives all the time on our website, which is where we see a new trend or a new idea coming, and that we think is super attractive. And a lot of times those ideas get turned into fruition, and investors are focusing on it sometime later. But, I remember a time when the concept of multifamily, let's take multifamily apartments because it's the easiest one to pick on. It's that, a decade plus ago, the concept of smaller apartments with amenitized space was relatively new. And there was a hard shift from an investor appreciation of their product because of the belief that people underwrite to dollar per square foot. But when you start talking about smaller footprints, 500 square foot units, 750, even micro units, the dollar per square foot you're paying is a lot higher. But what you're really doing is appreciating that the social amenities that a property offers aren't getting factored into that number. So a dollar per square foot is a poor characterization as the apartment market has moved and the product has changed. Now, why has the product changed? Because the millennial generation has become more focused on social interaction, more focused on being outside their apartments. They don't cook as much. And so their focus has shifted for what they want as a product. Now, that shift happened a whole bunch of years ago, but when it happened, not many people were thinking that was something to put capital into. Now, I remember we were trying to raise capital for an opportunity like that 12, 13 years ago, and we had a heck of a time raising it from the institutional universe who said, Dad, we're focused on dollar per square foot. Renters are not going to focus on just all-in number. And I said, well, actually, they do. I don't think people go into an apartment with their tape measure and say, what am I paying dollar per square foot, the average tenant? They're focused on what they believe they're getting for their money. What am I getting for my rent? And that's a broader conversation around a dollar per square foot number. Fast forward for today, that's where the market is. That's where the market is. People are focused on pools and bike racks and dog walking services and pool rooms and all these additional amenities around a newer product for multifamily, higher ceilings, all these things, because it's being responsive to how the market has moved, right? And so that's what I'm finding is a very, very interesting trend that has occurred. Another one, we can go space by space as to where we think the industry has moved on things. But it's all driven, and this is why COVID's been super interesting from a real estate perspective.
I was about to ask you about that, yeah.
Yeah, when newspapers were focused on the hotel sector and e-commerce and retail, they were missing the opportunity that was focused on, well, if people are moving, that means they're living somewhere different. Are they going to an office or not? How are they going about their shopping? And then to serve them as a customer, how are you getting the product to them, right? So if you talk about e-commerce, I understand the conversation around are they in a mall or not. But if people are shifting the way they're buying a product, then you're reshifting the entire real estate industry. Because now I've got to deal with cold storage, I've got to deal with logistics, I've got to deal with industrial. And so what we've seen coming out of COVID is the emergence and ultra focus on last mile logistics. We're focused on cold storage. And what has that impacted? You start looking at then, Kroger's converting part of their supermarkets to, delivery centers, right? And so you've seen a shift like that because somebody has moved. When you start having mass migration pattern changes like that, it has an impact on the entire industry. That's what was really interesting because the real estate sector knew it. And so for folks that are on the ground, it's whenever there's a disruption in the market, real estate investors think it is an opportunity and there'll be winners and losers out of that. But those that focused on those shifting patterns, right, and made right calls on that, will turn out to do very well indeed.
That leads me to the next thing, which is basically we are at a very interesting times right now. Many say a recession, in the midst of a recession. Some people say in the beginning of it. Some people say we don't know. A lot of people say a lot of things. But in fact, nobody has a crystal ball, but we feel the downturn right now. We know it. Big question that comes when I'm interviewing someone like you, who are dealing with so many asset classes, so many types of operators, owners, etc. Meaning the thing that I want to ask you is, where do you see the market going? You see the needs. You see who's coming with more deals, who's coming with less deals, who's coming with more need of capital, who's coming with more innovation. And obviously you have the winners. You can pick them here and there, and they are from any asset class, of course. But which asset class today, in your opinion, or from your research or from your last report that you guys have produced, is the winner right now, and who is the loser? If you could give us a little bit of insight with that.
Yeah, good question. So I think within any sector of real estate, there's always winners and losers. And within any sector, there's always machinations and niches within any sector. So I don't think in any sector in particular, you can just call it as a sector, as opposed, you got to take a look at it. Office has definitely struggled. That one's an easy one. It has struggled. But the and retail struggled less. But, we got a couple of retail deals done during COVID in the retail sector. Why? Because real estate's a local market business. And so the quality of the opportunity depends on the quality of the operator, where it is, and exactly what they're doing. I think what we can say is that, yes, this is a leverage-driven business. Real estate is a leverage-driven business. And the problem with interest rates rising is it makes it more expensive to acquire it. The challenge the industry's had is that the fundamentals have still been strong across the industry. So on a seller, if you were a seller or you were trying to capitalize, the fundamentals are still strong. So it's hard to get your head around, well, why is my property worth less when the fundamentals are as good as they were yesterday? But from a buyer's perspective, it costs more. So what we are seeing to bridge that gap, as the market has struggled to figure this out a little bit, is that we're starting to see a class of real estate investors that are simply acquiring with all cash and will take the risk that the debt markets and the credit markets will stabilize, right? And so as a result, they're able to get opportunities with strong fundamentals where there's a lot less demand, a lot less buyers are showing up for every deal right now. And so they're able to capitalize on that because they have the financial wherewithal to be able to set it through and wait until the market stabilizes. I think, look, interest rates are, whenever they're increasing, more than anything, it creates uncertainty, right? I'm not sure interest rates are out of whack with where they've been historically, although it's been wonderful to enjoy the cheap capital rise. But I think we'll find that, we will start to see a sorting between those folks that are good investors versus those that were lucky and rode the wave of cheap capital. And so there's a lot of parties that have really good track records over the past 10 years. But what we'll see now is those folks that are actually good investors, know how to underwrite good real estates and good opportunities, and just weren't, because when capital is relatively inexpensive, it's a lot easier to be a rock star.
Tell me something. Today, thank you for this, by the way, but today when we're talking about raising capital, it's a lot harder to raise capital today.
Yeah.
And I'm sure you feel it too. When you have someone finally who's coming with capital, I would divide it to two sectors when it comes to a firm like yours. And I would divide it to the high net worth individuals, family offices, and the funds, okay? Whether they're larger, meaning I would say mid-sized funds or large funds, both are looking for deploying capital, and they're very picky. What are they looking for today when they ask you?
So folks today are still, it depends on the fund, but a metric, and it depends on the sector too, but metrics folks are looking at is replacement value. How much does it cost to replace what we're saying? They're looking at whether there's negative leverage, and whether you have to believe that interest rates are going to come down. You need to believe that you'll continue to get NOI growth consistent with where we've been for the past couple of years, and whether you believe that story. So there is some risk there as folks are looking to underwrite those two things. But I do think there is a wealth of capital that is out there, and they're looking for good opportunities, right? And then I think the other part in that is there's an enhanced focus on social infrastructure, ESG mandates, sustainability, which leads into affordable housing as a product class, green energy, and focusing on, we just put out, or we'll be writing a piece on battery storage. It's looking at those angles that are the new opportunities that have been created out of the past couple of years.
Very, very interesting. It's really interesting what happened, like lately, what was happening with logistics, obviously, with warehousing, how it took basically the e-commerce shifting from the retail, moving more to warehousing, and now they're all kind of mixes, like all kind of creative creatures that people have made, basically. And the same stuff is going on also with office, which is a completely different thing, where office is more correlated with the housing, residential, meaning people more working from home, going to the office. We see that office is needed at the same time, but people are combining. Leads me to ask you about office now. What is the future of office, you guys think? Meaning, obviously nobody knows, but where do you see it, going? Where are the smart investors who are doing office for many, many years, who are looking to the future? What are they doing today?
Well, look, I think for office, it's a replacement cost issue. At some point, the office sector has struggled for many years now. And part of the challenge with older vintage stuff is what can you do with it? People are talking about conversions, but you got to pencil the economics on conversions for them to work. But I think, there's a group of investors out there that think at some point here, the office pricing will reset such that it's worth it from a replacement basis perspective. And so that'll make it interesting. But I think in general, your point on office is that the market is not going away anytime soon. Although we were an early proponent in COVID saying the remote working concept was here to stay, and that we had institutionalized work from home practices and it was no longer a one-off. And so the market was going to have to accommodate that. And so the question then becomes twofold: is for office space that you have, do you reconfigure it? Do you need to keep it the same? And laying into that is the logistics side of it. So if you're going to have a concept, there's one school of camp saying office spaces do not get smaller because the logistics of having people in and out of space means you still grant space for those employees, right? So because you're never going to have all your employees work from home. If you're going to have some back, does that mean you got to have a schedule and then you got to deal with the logistics of it? Or versus, can you reconfigure a space and move it away from, for example, offices into open workspaces, more meeting spaces, more conference rooms, more virtual and remote working systems for people to come in and out of offices. So I think the jury is still out on that. I think the two things we know for sure is that the remote working is here to stay, and it will, because it's institutionalized. And two, but it's not going to be all work from home. So you will still need an office space, and whether that results in smaller footprints or simply reconfigured existing footprints, I think that's going to be a case by case for each corporate.
Very good. Very interesting. Before we go, I just want to ask you about locations, growing markets versus markets that are not so attractive. Mm-hmm. And when I ask someone from a firm like such as yours, it's very interesting to me because you're on top of things all the time. What is your take on that?
Yeah. Again, COVID was interesting in that it encouraged people to move out of larger cities. It may have been intentionally thought to be part-time, and maybe it's turned into something more. But I think what we are seeing is there is an increased focus on non-big urban markets and a drive towards suburban markets throughout the Midwest. The Smile states, the southern states, have been beneficiaries of that. Right. And every market, it is a local market business. So some local markets will have great population growth and some will not have great population growth. I think it is very sub-market specific. But what I think is easier to get our heads around is that there is a belief that some of those markets have held up very well and are actually had increasing population growth than what otherwise if COVID had not come. And then, of course, and this trend was already taking place well before COVID, and we were certainly seeing it, is there is a distinction between high tax states and low tax states. And the high tax, what we're seeing is corporates trying to deal with that very creatively. And that may be having a corporate office in an urban center and then setting up regional office or remote offices in low tax states and then having employees in that low tax states, or they're setting up just remote offices and separate offices and hiring into those in those less popular, the less tax states than they were before. But because of that, and because COVID also facilitated migration out of the city, it meant that the return to more regional centers is here. And again, you're institutionalizing it. So people have already made those choices. And so now there is this shift in the market where population is becoming more spread out than it was a couple of years ago.
Very interesting. Last thing, New York City. Obviously, your office was there and you moved to Stamford, Connecticut, which is very interesting. What do you think is the current shifting, I would say, trends in New York City? What's happening there?
Yeah, so look, I think the tax situation there is hurting a lot of businesses, for sure. New York has had an extraordinary reputation for many, many years as a powerhouse and as a center of commerce and finance. I think that definitely got challenged during COVID. And so folks are becoming increasingly spread out, and you're seeing a lot of big ticket corporations are moving out of the center, all the big city centers, and are locating elsewhere. And I think that trend, as people become, because of Zoom and some of these other things too, that you can facilitate business, do well in business, and you do not have to be based in these large metropolitan cities. I think that trend will continue. There is always the enamor of being in New York City. I lived there for many years. But I will tell you, we were very happy to move out in 2020 and on the belief that we didn't need to be there anymore. There's been so many firms, financial firms, that had moved out of New York that I think they've set up other areas now. And so, we're in Stanford. There's a lot of firms out in Stanford now. And I think there's many more locations that are just like that. You don't need to be in New York City to be a successful company or to be even viewed optically as one.
Beautiful. Deb, I'll tell you what, this is exciting. We could go on for hours. You know what? Before we said our goodbyes, if you could tell everybody, and you guys can see the links above and below, if you could tell everybody where they can find you guys, whether LinkedIn or a website. Go ahead.
So we have LinkedIn. I have a LinkedIn. You can find me, Deborah Smith, CenterCap. CenterCap Group also has our LinkedIn site, and we have our website, www.centercapgroup.com. We post our perspectives there, as well as news and deals and things that we're working on across both LinkedIn and the website. Or you can feel free to reach out. I'm happy to connect with anyone who wants to bounce anything around or wants an opinion. I certainly pretty much have one on everything. Beautiful.
I really enjoyed this interview. Thank you so much, Deb. Really.
You're welcome.
And stick around, you guys. I hope you guys learned so much from it, because, rarely we have an opportunity of someone who's, I would say, cross-country, all types of deals, all types of things within the commercial real estate sector. And that was a treat. Thank you so much. Really appreciate it.
You're welcome.
All right, guys. I hope you enjoyed it. I'm going to see